Every evening across Europe, hundreds of millions of people turn on the lights. Meeting that daily power demand became a structural challenge for the continent in the mid-2020s, necessitating a permanent energy alternative to Russian gas. Simultaneously, European leaders faced compounding pressure from migration across the Mediterranean Sea, captured here as a Libyan Coast Guard boat approaches a migrant raft. South of the Mediterranean, Egypt faced a parallel domestic crisis. Severe currency devaluation and a liquidity drought, visible here, threatened the country's stability. With borrowing costs at unsustainable levels, the Egyptian government was effectively locked out of traditional sovereign debt markets. These mutual vulnerabilities forced both sides to the negotiating table. This wasn't an alliance based on shared democratic ideals, but a match born of economic necessity. In early 2026, those negotiations culminated in the signing of a €7.4 billion strategic partnership between the European Union and Egypt. This package is distinct from traditional foreign aid. It is a calculated, multi-tiered financial transaction. To see how this deal shapes the future of Europe's borders and energy security, we have to audit the receipt to see exactly what is being bought and what Egypt is trading away. The deal spans 3 tiers. The largest is €5 billion in concessional loans, provided at below-market interest rates. This liquidity bridge requires fiscal reforms to stabilize Egypt's economy and prevent default. Tier 2 allocates €1.8 billion for investment guarantees. These guarantees act as a buffer for European companies, lowering their entry risk so that private capital can flow into Egyptian infrastructure projects. Much of that capital is destined for energy projects, like this coastal facility, to expand Egypt's liquefied natural gas export capacity for European markets. It also targets the development of massive solar and wind farms, such as this one, which are intended to feed directly into Europe's energy pipeline. To streamline these exports, the deal includes funding for port and logistics infrastructure along the Mediterranean, as seen here in Alexandria. Through this combination of loans and guarantees, Europe is paying to physically integrate Egypt into its own energy supply chain. This brings us to the final, smallest tier, €600 million provided as direct, non-repayable grants. Unlike the loans, this grant money is conditional upon a specific political objective, active migration control. Egypt is expected to use these funds to police the Mediterranean and intercept migrant flows before they reach open water. This reflects the strategy of externalizing migration management, the practice of paying transit countries to enforce borders far beyond Europe's physical territory. With this €600 million grant, Europe has effectively outsourced its border security to a neighbor in need of financial support. The global financial markets reacted almost immediately. Multi-year backing from the EU instantly lowered Egypt's short-term sovereign risk. This reduction in risk allows European megacorporations to establish a dominant position in North African infrastructure and energy markets. On a macro level, Egypt has now positioned itself as Europe's primary gateway for regional capital and trade. This strategy represents a shift in European statecraft. As seen here at the European Commission, the focus has moved toward using aggressive capital deployment to achieve political and energy goals. The EU-Egypt Pact demonstrates a calculated logic that a superpower can secure its borders and energy grid by purchasing a structural multi-billion-dollar stake in its neighbor's survival.